Good morning. Thank you for joining PHCA for today's webinar, Achieving Medical Cost Savings Together. I'm Wendy Johnson with the Pennsylvania Healthcare Association. PHCA offers monthly webinars to members to receive updates from department staff on regulations, learn from industry experts on current trends and practices, and to gain a better understanding of practical application tools to equip you so that you can continue to provide the highest level of quality care possible. Before we begin, I have a few housekeeping items to cover. This webinar is being recorded and will be made available on the PHCA website later today. Today's webinar is informational and not for credit. Feedback is important to us, so we'll be sending you a survey following the webinar. Please complete the survey, and if you're participating in a group setting, have each participant also complete the survey. All attendees will be in listen-only mode. However, throughout the presentation, please feel free to submit questions using your question pane on the right hand of your screen. Our presenters will address them at the end of the presentation. Now for today's webinar. This webinar is being presented by Rob Heller, John Kulp, and Sean Ireland, all with Brown & Brown Insurance. The cost of healthcare insurance has been increasing year after year with no end in sight. Fueled by skyrocketing prescription drug prices and rising facility fees, these services have become a large portion of a group's overall cost. Employers haven't had a way to bend this curve back in their favor until now. On today's webinar, you'll learn how the health insurance program through Brown & Brown can potentially save your organization a significant amount of money, both now and for years to come. They will show you how the innovative proprietary programs immediately target high-cost items and provide real-life examples of savings. Along with this, they will also explain how banding PHCA businesses together in these programs will provide risk mitigation and more stable rating for the long term. I'll now turn the webinar over to Rob, John, and Sean.
Great. Thank you so much, Wendy. We really appreciate it. This is Rob Heller, President of Brown & Brown in Pennsylvania. We are a full-service insurance organization. We have offices throughout the whole state of Pennsylvania. I do want to thank Wendy and PHCA. I've personally been actively involved with the organization for over 25 years. It's a fantastic organization. We actually handle the group medical plan for PHCA and have been, again, actively involved in the association for a long time. So thank you so much, Wendy. The first thing I'll just pull up is the standard disclaimer and legal notice. We are not lawyers and are not providing any legal advice as it relates to this. So I guess the big question is, as it relates to medical insurance, obviously that's just a huge pain point for organizations of all different industries across the country. We know that's well documented. Medical costs have been out of control for years and years and years with no end in sight. In addition to that, for most businesses, it's the second biggest line item for them after people expense. So it is something that we really need to get a handle on. And honestly, I've been doing this for over 30 years, and I feel that in the last couple of years, it's the first time there's some unique opportunities to really change the cost curve of medical insurance and do some unique things because of some factors that are happening in the marketplace. So what we're going to talk about today is an opportunity where members can band together to take advantage of group purchasing power to reduce overall costs, and through some proprietary programs, as Wendy mentioned, that we have available through Brown & Brown to really change the trend that's happening out there. Again, just going through the bullet points, we realize medical costs are out of control. You've seen it in your organizations where you're getting 15% renewals on top of 20% renewals on top of 10% renewals, and it just becomes very difficult to sustain that. In addition, the big question is, okay, Rob, why now? I've been a member of this organization for 10 years, for 15 years, for 25 years. Why now is there an opportunity for us to band together that didn't exist before? And there really is a unique set of circumstances happening in the industry right now that allows us to do this that didn't exist even a few years ago, quite frankly. frankly. Some of it has to do with new products that are coming into the marketplace. Healthcare is changing. There's third-party administrative firms that can handle things differently. There's the ability to aggregate various programs. And again, these things didn't exist even a few years ago. So that really creates this unique opportunity, as well as some of the proprietary programs that we'll get into today. And then in addition to that, there is pending legislation that is called Association Health Plan legislation. The Department of Labor came out with some initial rules. Historically, you haven't been able to band together just to purchase medical insurance. And we feel that that's going to be changing based upon this legislation that will be announced within the next, we think, 60 to 90 days, which will create a few more opportunities as well. So let's start talking about the advantages. Again, at the end of the day, the big thing to keep in mind is that it's the group purchasing power of the members. Anytime you as a sole organization are out there negotiating your behalf versus a collective force of many members, we just have leverage. It just makes sense in any business, and that's exactly what we're trying to do. So things like stop loss, again, don't want to get into the weeds too much, but you could either be fully insured, meaning you pay an insurance carrier a fixed premium, or you could be self-funded. If you're self-funded, you have to purchase stop loss to protect you on the upside or downside as well. So we can, again, aggregate for stop loss. Certain drug programs we can aggregate, and again, Sean and John are going to get into it. The underlying cost of medical expense, again, through proprietary programs that we have in the group purchasing power, can reduce the cost, which is really, at the end of the day, the biggest driving force behind the rate increases that you're seeing. Administrative fees can be aggregated to lower the cost. Quite frankly, broker compensation, if we can do this on a larger scale, each individual piece of that's built into it for consulting or brokerage services can be reduced. By banding together, we can also create transparency tools. One of the problems we all know with medical insurance is it's not transparent. It's very difficult as a patient or individual subscriber to really understand the true costing to go to low-cost alternatives. We can create the transparency necessary. Many organizations also struggle with renewals that go up and down, and you have no idea what to expect. By banding together, we can start to levelize the renewals so you don't have those huge swings of rate increases, as well as it makes it much easier to budget. Again, if you have no idea what kind of rate increase you're in for, and then 30 or 60 days you get a 20% increase, it's very hard as an organization to handle that. And then the last advantage that we have is by banding together, we'll have access to claims data at a level that you never had before. So if you're fully insured, you really don't get any claims data. And with our vehicle, you'll be able to get information that in terms of claims data so we can attack the true cost that you didn't have before. So let's just talk for a quick second about really at the end of the day, what is wrong with healthcare? A lot of people say, oh, it's the insurance company. Oh, it's the provider community. It's the pharmaceutical. And quite frankly, it's kind of a combination of everything. So really, the issue is that you have individual silos. So you have insurance company as a silo. You have the provider or hospital as a silo. You have the pharmaceutical piece as a silo. And quite frankly, I'm going to throw brokers into there as a separate silo. And these individual silos have been operating a certain way for years and years and years. They have their own business model. They have their own margins that they're trying to protect. And it's very difficult sometimes to get under the cover, so to speak, into that silo and really understand how we can get into the silo and to reduce the overall cost for each member. And we feel we figured it out, and we're going to kind of go through some of that today. Again, these businesses, they have old school leadership. A lot of time, each of the silos talk about change, but really they're just trying to kick the can down the road. We know there's strong lobbying efforts, again, backing up each of these silos. The politicians, clearly haven't agreed how to fix it. So again, what we've done is take it upon ourselves as an organization to get into each silo and figure out how we can reduce cost as it relates to those silos. So I'll just start with the first one before turning it over to Sean and John. The first one is the insurance company silo. Again, they have their own silo, own profit margins. we've kind of figured out how to get into that silo to, at the end of the day, drive down costs. Some of it has to do with becoming self-funded as opposed to fully insured. Again, it's aggregating stop loss, and again, a couple of other things that we're going to talk about. I'll now turn it over to Sean for the next silo and kind of talk about some of the things that we're doing as it relates to that.
Thank you, Rob. Another silo we like to identify here is the provider and hospital contract. So traditionally, groups sign a contract with the insurance carrier and just kind of accept the rates and the reimbursements for the providers and the hospitals. We've taken a look at that. As Rob mentioned, we kind of look under the hood there and look at the mechanics that are driving those prices and try to find innovative strategies to keep those prices down and actually save money at the group level and improve care for the employees as well. So you can see that a list. We actually work with some direct provider contracting, explore reference-based pricing. We have some data analytics tools that can dive deeper into those costs and trends. And also we have some transparency tools, which I'm going to talk about here next. One of those transparency tools is a program we developed called ACT. It stands for Attacking Costs with Transparency. And interestingly enough, healthcare pricing and healthcare shopping is one of the only things we do as a population, which we don't actually shop. We all go to the doctor, we get our services, and then we just trust the insurance carrier to pay the bill. That comes out of our deductible or our company's overall cost, but we never actually look around to see if there are better pricing for things that are consumer-based. So consumers don't price shop, they just go get their copay or pay their copay and pay the part of their deductible, and it's convenient. We all go to the closest place, the closest facility, the closest blood work lab, get our services, and we leave. But what we don't realize is that price can vary wildly for the same routine medical care. For example, colonoscopies, any sort of high-tech imaging, blood testing, and most outpatient services, those costs can vary wildly for those kind of tests. Here's one example. So right here in Central PA, we have a 5-facility example for a medical lumbar MRI. All right, so you can see the extreme cost difference between those 5 facilities. On the low end, you're looking at $350, and for the same exact service on the high end, you're looking at close to $4,500. That's crazy. That's a huge difference, and most consumers don't even have the chance to see that because we don't check and look around. Here are some more stats to back that up. 75% of healthcare spend is on preventable chronic illness, and 30% of a company's medical spend can be saved on those routine services we just gave examples of. All right? The top 10 routine care items make up over 50% of a company's medical spend, yet employers don't know these cost drivers by test name to create solutions. So your employees just go get these tests done. They show up on your experience report and your claims report, but you don't have those by name. You don't have the data or the information to be able to shop those effectively and see if there is cost savings for a higher quality of care. And routine care currently does not have itemized pricing. You can't really go on anywhere, any site, any sort of forum to find the cost on those. You have to actually call each facility directly, get that person to tell you what their reimbursement level is, if you can get that, and then do it manually. Here's another good example. So the green bars here represent the estimated payments with a Blue Cross Blue Shield plan, and the orange bars represent a median charge without insurance. Let's just focus on this example for the green bars. Colonoscopy on the low end in the same area can cost $559. On the high end, you're looking at close to $4,500. Again, a huge swing for the same exact test and the same exact service. That difference in $4,000 could be a savings to your organization and your employee. So what we have is a medical price transparency tool. The goals of this tool, it's obviously to itemize and identify high-cost care items by provider, so you as an organization and we as brokers can help guide employees to the low-cost, highest quality in-network care. Obviously, across the board, it's going to save everyone money. This plan, this transparency tool includes over 600 care items that include things like blood work, high-tech imaging, and outpatient surgery procedures. The plan does afford access for a patient advocate and navigator to help employees price this, so they're not there on their own. They can actually use an advocate to help them and ask questions. And each employee enrolled in the plan gets a custom ID card based on their zip code and their healthcare plan. So these cards will be customized for whichever provider network you participate with and where that employee lives, so they can see in their area what the best cost is and what the best price is and the highest quality for these services. It's not a one-size-fits-all model. We understand that's where this plan takes place.
So one of our other proprietary tools is a data analytics system called Inovu. The big buzzword right now in the industry is big data. So with that being said, what does Inovu bring to the table? Really what we're going to bring you is data that you don't have or that you haven't necessarily had access to. But secondarily to that, we're going to take that data and we're going to take action with it. So what this tool allows us to do is it allows us to identify. So one of the things that Sean had spoke about, the provider silos. We're very big right now in the market with direct provider contracting. So if we could use this tool to identify some of the lower cost facilities, we will proactively reach out to those hospital facilities and cut a deal for our membership. It's called cash bundled pricing. So members are getting a much more affordable or competitive price, and you as a employer are seeing that in your claims dollars rather than paying what we're calling the private insurance discount. Some of the other examples are we're able to dive into certain conditions and prevent gaps in care. A real example of this was we have a 300 life group up in northeastern Pennsylvania. We found that there was a heavy or a significant population of folks that had blood pressure and diabetes that were not adhering to their routine medicine or maintenance meds. So what that allowed us to do at renewal is we put in a $0 copay design for maintenance medication, specifically for diabetic and blood pressure drugs, to make sure that those members are now compliant moving forward. One of the other silos, and arguably the most significant silo here, we see medical inflation somewhat stabilizing in our markets, but what we're not finding and what you're not going to see over the next 5 to 10 years especially is prescription costs are going to still continue to go through the roof. So one of the things I would ask you to take a look at, whether you're fully insured or self-funded, look at some of your claims data if you're receiving it, and you will find that the same drug for the same dosage, for the same utilization, nothing changes. Quarterly, those drugs are jumping anywhere from 6 to 8%. On a 6-month running basis, they're jumping 15%. Nothing you can do about it, just the manufacturers continue to increase the price. So what we've done is we've gone out to the market and we've branded and protected 3 different prescription drug offerings. What you see here are the names of those: Scripts for You, Generics, and Simple Fill. To jump into each of these a little bit, we're gonna kind of set this up. So as Rob mentioned earlier, lobbyist costs, politicians. Right now, the #1 source of lobbyist revenue in the United States is pharmaceuticals. To put that into perspective for you, gas is number 6. So that's how much money is being thrown around in the prescription arena. Without diving too much into the weeds, this slide just shows you, gives you an idea of the layers and the shell game that's played in the prescription arena. The next slide speaks to probably the most significant trend is the specialty drug trend. So by 2020, a lot of analysts are predicting that specialty drugs are going to be almost 50% of our drug sales. So what can we do about that? Well, the first program that we're going to bring to the market, or that will help you sustain these costs, is a program called Scripts for You. And what this is it's a voluntary prescription drug plan. So all these programs, these next 3 drug plans that we'll go into at a high level, they stand beside your current PBM or prescription drug offering. What we realize is we don't want to have any member disruption. So it is not a substitute, it's a supplement rather. So again, it's a voluntary prescription drug plan. We actually, the list here, the slide references 200 meds. We're actually, with the recent update we did this last quarter, we're up over 330 total meds on this list. We have a list for regular PPOs, and they are also HSA compliant according to the IRS compliance guidelines. The biggest piece here is there is no cost to the employee, and the employer sees significantly reduced claims. So some examples of this. The next 2 slides, so without going slide by slide, one's a branded slide, the other's a specialty drug slide. These are real examples of the pricing that's available to you through the Scripts for You program. You're going to see drugs on here for conditions such as rheumatoid arthritis, MS, chemo drugs, diabetes, and cholesterol. So how does the Scripts for You program save you money? Well, as we mentioned, it's brand and specialty medications, and if you look at those slides, some of these can provide up to as much as a 90% savings. As we mentioned, employees have no out-of-pocket expenses. The big piece really comes in premium concessions. So our stop-loss vendors on the self-funded programs are giving us anywhere from 3 to 7% on your fixed premiums, which is a huge piece of the pie. And then these savings are consistent year over year. A second program, this is in full transparency, this is a program that we've just rounded out and brought to the market in the last 2 months. This is specifically for generic medications. Right now, our average utilization is about 89% for generic utilization across our book of business, which is great. But even with 11% branded utilization, we're seeing that can be 3 to 5 times the cost of generic drugs. But what we're also finding is there's a term out there called single source generics. And what this is when a brand drug patent expires, the FDA grants exclusivity for up to 6 months for that same brand manufacturer to make the generic equivalent. What happens then is that branded manufacturer controls the whole market, and they can still set that generic pricing up high. So what can we do? Well, we have a program now in generics to combat that. This list is over 1,200 total medications. 750 plus meds are HSA compliant. It provides a transparent fixed pricing to you and your members up front. And as we mentioned with the Scripts for You, the cost to the employee is zero. There is no co-share. The savings to the employer is in the total cost of the drug. This is also a program that provides premium concessions for us with carriers. Results: lower RX benefit spend, creates branded generic drug conversion. As we mentioned, it complements your current RX program. It is not replacing it, which again is huge for no member disruption. And it presents both a savings to the employer and the members. Lastly, we have a Simple Fill program. This is more of a manufacturer subsidy program that's been out in the market, in the individual market for quite a while. We've put some extensive work into this to bring this to our group clients and employer clients at a group chassis, we'll call it. It is an income-based program, and sometimes they do consider the benefit levels under the prescription copays. But what essentially this program brings is there's 130 branded and specialty meds available under this program. And if your members would qualify, it carves the whole cost and utilization of these high-cost drugs out of your utilization, which results in lower renewals, lower utilization, and lower overall cost. To give you a real-life example, our second group that we implemented in this about a little over a year ago had a member that was taking a drug called Ibrance. This is more of a breast cancer / oral chemo medication. That drug at the time was $135,000 through the PBM. We got that drug for that member at no cost. The client, the employer for the services, paid $720 annually, and that $135,000 med was carved out from their bottom line, essentially resulting in more than $134,000 of savings. That's huge, and that's just one drug example.
In the last silo, we kind of talked about initially, so again, we have insurance company, we have the provider, we have the RX, and quite frankly, there's another silo called broker that we're part of. And again, our feeling has been that the broker community is a separate silo and really hasn't been creative enough in working with their clients to reduce costs and put them in a better spot. At the end of the day, you'll see on the left-hand side a traditional broker. They may have that, what we call value-added services, COBRA, some HR services. In the middle, what we call the blocking and tackling, handling claims and providing service. But there's very little effort made on strategic thinking and actually coming up with solutions to drive down costs. We feel we're different in the sense that that's really the big focus of our point. Yeah, we do provide COBRA. We have fantastic HR services, et cetera. And we certainly do the blocking and tackling as well as anyone. But our main focus is on the strategic thinking. What we can do, we wake up every day thinking how we can reduce our clients' costs. So again, I think that's another silo that we've broken into and have kind of changed the model as it relates to that. And by the way, we only have about 5 minutes left. I know we had blocked blocked off an hour, but we're respectful of everyone's time today and just kind of wanted to go high level. So at the end of the day, okay, as we're talking about banding together and doing this, obviously I'm sure there's certain concerns or challenges that you would see, and we see them as well. So we thought we'd at least address them and talk about that. Number one is once we do band together, everyone would have their, potentially their own network. So because we're within the state of Pennsylvania, Pennsylvania is unique in the sense that we actually have 3 separate Blue Cross plans. You have Highmark out west and in the Northeast, Capital Blue Cross is in the Central, and then Independence Blue Cross is in the Philadelphia marketplace. So that creates a challenge. If you have one vehicle, could each individual member have their own network? Could it be the Blue Cross that's local to them, or could it be Aetna or United? And the answer is yes. We feel as if we could put together a vehicle where we'll have purchasing power, but yet allow each member to have the advantage of having their own network. So that's something that, again, as we go through this process, we can talk about. Really, the biggest challenge, how do we get started? And we're going to talk about a way that we'll collect data, and then we'll be back to you in a second, but the challenge with all of these type of arrangements is getting the first couple on board. We're all individual members. We have our own issues and concerns and things that we have to work through. But how do you get the first couple involved to do it? Because once you get that, you get some critical mass, and it's much easier to move forward. So we certainly recognize that challenge. And then the last thing is that, let's just get it on the table. Many of you have broker relationships existing, long-standing relationships, and we get that, and we appreciate that. In some cases, it may mean changing that broker relationship, but we think that there could be some opportunity if we can come up with this vehicle, if you feel strongly, to let your broker participate. Again, as we go along, we can certainly have those kinds of discussions. So really, what is our kind of main message, and how do we wrap this up, and how do we kind of get started as it relates to it? I think we start with that kind of an ending point in mind and then work backwards. So our goal would be to have this vehicle up and running by 1/1/2019. That would be the goal. Again, usually these things take 6, 7, 8 months to put together, so that would be the goal. So we need to start collecting the data from each of you, starting soon. If you could get us the data that we need, and we're going to outline in a minute what that data is by June 8th, then we'll collect that data, start negotiating with various vendors, putting something together, and then come out and meet with you individually. We realize each of you will have a unique set of circumstances, each set of issues that we need to address separately. So our goal would be to collect the data, band it together, come up with the pricing, and then at the end of the day, come meet with you individually and kind of show our results. At the end of the day, we're not asking for any commitment to provide the data. There's no commitment. We certainly realize that this is just to provide the data to see what we can come up with. Again, we realize you have broker relationships. We respect that. They certainly can do their thing. We're not looking at this point to interfere with it. But my thought would be, why not have another set of eyes to see what you could come up with as it relates to this program? Again, there's a unique set of circumstances that exist right now that will allow us to take advantage of it. And I'm going to turn it back over to John to outline kind of the information that we need and just make sure we're on the same page.
Yep. So to sum this up, as far as the data, a lot of it's going to be basic data. As far as an employee census, we would prefer a lot of carriers, especially on the larger thresholds, are looking at a member level census now versus a subscriber level census. So the start would be the census. Especially if you're fully insured, the last 2 to 3 year renewals play a key role. Current plan designs, and the meat of this really lies in the claims info. We do recognize that if you are fully insured, the data that you may receive is somewhat limited, but carriers are starting to get more adept at providing some types of basic reports, whether that's an aggregate report, high claimant report, lag reports. Any type of data that we can get, the more the better. So the 4 basic ones to sum it up are the employee census, 2 to 3 year renewal history, plan designs, and claims info. And we're asking to have this information by early June. What we will be doing is, so we have Sean's contact information here. Sean, myself, and other members of the team in the interim may be reaching out to you proactively. Just to touch base, as Wendy had said, there is going to be a recording of this webinar available. But with that, we kept it short for a reason. We would like to answer any questions that are out there. And once again, thank you, everyone, for your time.
Thanks, gentlemen. Thanks for the great information today. I don't know anybody who doesn't want to save some money. So at this time, we're going to open up for questions and answers. Please submit any questions that you have on the right hand of your screen, and we'll give it a couple minutes for your questions to come in. The recording and the survey and the Brown & Brown contact information will be made available. I'll be sending that out in an email later today, before the close of business today. So if you think of something that, you're going along in your day and you think of something later on, you can certainly get in touch with them, not a problem. All right, we do have a question here. Is this a shared risk situation? Will our rates going forward be affected by other claims?
Yes, that's a great question. So as Rob mentioned, we are looking for this program to essentially be a shared risk program. Aggregately, the more data, the more numbers, the more buying power we have, the more risk we have spread out over the layers. Recognizing that in the early stages, getting this set up, we want to make this very customizable and flexible, meaning we don't, as we've mentioned, we don't want to disrupt networks. We don't want to disrupt plan designs. Some folks don't want their renewal date disrupted. So while it's going to be an aggregate risk share on what we'll call the stop loss or reinsurance level, below that, we're looking at keeping the plan designs for the members, the renewal dates, et cetera, all intact without disrupting that.
Great, thank you for that. Any more questions? Here's one. Do we become the insurance provider? Do we need to add a rider to our commercial package for employee benefits?
So to answer that on a high level, without getting into the weeds, and I hope I'm not misunderstanding, Wendy. What if on a self-insured model, the employer essentially becomes the fiduciary, but there's provisions within the stop loss contract that we will scrub for the protection of the employer. At the end of the day, from an addendum or a contract, as far as protection to the employer, we do not see any of our self-funded employers doing so. And I may not be getting in the weeds or, again, misunderstanding that, but essentially what we're looking at here is everybody would be under a self-insured model for the risk share. You would be the fiduciary as the employer, but we make sure from the insurance coverage and the stop-loss contracts, the protections are in place there.
Great. We have another question. In order to participate, is there a minimum number of employees you have to sign up?
So another great question. So as we mentioned, healthcare is not a one-size-fits-all answer. We want to provide a solution to everyone. This is where I think some of the small employers benefit from the larger numbers, and even the larger employers. We get several to jump in as that membership grows. Again, the buying power is there. But to sum that up, no, there is not a minimum size to jump in. Preferably, if you were going for self-funding standalone, the market now has an appetite down to 10. We would not advise necessarily for a group of 10 from a risk standpoint to go self-insured by themselves. But under this model, from an
Sean, you just cut out on us.
Are you there, Wendy?
Yes.
Our phone went red for a second. I apologize. The long and short of the answer, and I don't know where I cut out, but there is not going to be a minimum size threshold on this, no.
Okay. Any more questions? Like I said, if you think of something later on, I will put, I will have the contact information for Rob, John, and Sean, and I'm sure they would be more than happy to answer those questions at any time. Another question has come in. Will you require a wellness program?
Great question. One of the I'll say RFPs or process that we're vending out as we speak is ramping up some of our wellness efforts, not just relative to the association, but the market in general. So yes, there will be a wellness program offered. We believe in, from an ROI standpoint, we believe it has to be very basic, especially out of the gate. We don't want an employer that's not offering something to jump head over heels and have to do 5 things that they never had to do before. So just basic things as far as meeting with your PCP once a year, getting a preventative exam. We're looking at a biometric product and service that would be coming on site at no cost. So yes, there's some basic wellness programs that will be in the works and tied into this as well.
And this is Rob jumping back in. One of the advantages of this vehicle, and particularly the Inovu piece, is with the data that we have, we can really do what we call targeted wellness. So as opposed to general things, just people getting in shape and eating right, which is all great, and it's great for the culture, we can really get into the weeds and be able to do targeted wellness and close what's called gaps in care. The people that may have a condition but haven't been prescribed medication, or they've been prescribed medication and we can see that they're actually not taking it, and kind of figuring out a way to do an outreach to close that gap in care. So again, to me, that's one of the big advantages, is we can take wellness to a whole nother level that will really, at the end of the day, drive down costs, as opposed to kind of general stuff, which is great, but may not have that return on investment that we're looking for.
Okay, another question. Will there be any lasers in this program?
Great question. On the reinsurance lasers, we hate them as much as an employer hates them. So one of the initial items when we took this to market to vet this a year ago and putting this together was a no laser contract. And specifically, if we get the aggregate power of the numbers, there will be rate caps on renewals and so forth, as Rob mentioned in one of his slides with level renewals. And I think two go together. In the reinsurance world, sometimes you'll see a stop loss carrier put a no laser in, but then they're still giving you a 60 or 70% renewal if you have high claimant. So the tie together there is there will be a no laser contract, and secondary to that, there will also be rate caps to go with that no laser.
Okay, we have another question. Will there be any cost savings if meeting certain landmarks with wellness program, such as specific levels to be maintained, cholesterol levels, blood sugar levels, weight levels?
So yes, what we can do is, as with the Inovu program, as Rob had just mentioned, if we custom tailor programs, and this is where it's not a one-size-fits-all answer for a client. One client may like it, another client may not, but we do want to keep the claims steering in the right direction to keep them clean. So the performance of all the groups in, there has to be a shared performance threshold too. So yes, we're looking at putting performance metrics in for wellness. We don't, again, want to go too far to the end of the spectrum to make it too aggressive, but out of the gate, there will be specific wellness initiatives that are included to make sure that all members are sharing in keeping their population healthy, so to speak. It's a great question.
Super. Any more questions? We'll give it another minute or two. Since we're finishing up early, we'll wait and see if any more questions come in. All right, I'm not seeing any questions. Like I said, I'll send out the contact information if you have any more questions. The guys, I'm sure, would be more than happy to get back to you. And we can also send out, information from here. I'm sure we can include something in our, in our daily blogs and things along those lines to keep you up to date. Again, there's going to be a survey emailed before the end of the day today, and a recording of today's presentation will be made available on the PHCA website. Please take some time to complete the survey. Thank you again to Rob, John, and Sean for presenting this cost-saving opportunity. And everybody have a great day. Thanks for attending.
Thank you.